Alright, what's good, guys? Welcome back to a new lesson. Last time we talked about liquidity sweeps, and today we're going to be talking about some called a fair value gap. Alright, let's get into it. What is a fair value gap? A fair value gap, to keep it in simple terms, is a three candle pattern, right? Hold on, let me draw out three candles. Okay, so a fair value gap, three candle pattern, right? Um, it is basically uh when there's a big move and and during the big move, the first candle creates a wick, and then the second candle creates a big body, and the third candle creates another wick, and the first wick must not the first wick and the third candle's wick must not cover the body of the second wick. So yeah, so it leaves a gap here, right? So that's basically what a fair value gap is, and an example of what not a fair value gap is if the wick covers the whole body, right? So there's no gap here. Therefore, it is not a fair value gap, right? So I don't know if I explained that right, but um, yeah, let's find it. It let's find it in the markets, right? You can probably find a million fair value gaps here, and there's a lot that work and that don't. You can't just mark out a fair value gap and expect it to work, right? So hold on, let's find an example first. Here's an example of a fair value gap, another fair value gap, and then another fair value gap. Yeah, there's like a million fair value gaps, right? And then what is not a fair value gap? You probably would think this is a fair value gap, but no. These two wicks are covering the whole body of it, right? Another fair value gap, even the tiniest fair value gap work. Fair value gap, right? That's probably enough examples. Okay, how do you use fair value gaps? Okay, when there's a big move, when there's a big move, like big move upwards, there's there's a lot of imbalances, right? The market creates imbalances. Fair value gaps aren't the only imbalance. There's like also order blocks and stuff like that, breaker blocks and stuff like that. But today we're just gonna be talking about fair value gaps. All right, boom. Market has a liquidity sweep, takes out the liquidity, and then it goes up, creates a fair value gap here. It goes up and then it retraces down here, taps into the fair value gap, and then boom, rips up. So fair value gaps have uh, a strong attraction point, right? It um market is drawn to fair value gaps. It wants to fill them, right? So if you want to create a strategy from just what we learned so far, which is liquidity and fair value gaps. What the fuck? Fair value gaps. You could just find liquidity sweep. So boom, boom. You got liquidity sweep, and then a fair value gap that gets tapped into and respected. So you would enter in short here, stop loss at this high, and then target points of liquidity, right? We got relative equal lows here, which price is automatically drawn to because there's probably a lot of resting orders down here. You can't completely tell with candles, but you can tell with the order book, with order flow and the book map and stuff. But that is in later video when we get into more advanced stuff, right? You would target this point of liquidity, the maybe this point, and your final take profit would probably be down here, where you can probably take runners all the way, like, I don't know, bro. Yeah, so you would have gotten TP right here and would have banked a 3.5 R. Okay, let's find another example, a good example. Okay, alright, here's a perfect example. We got relative equal lows right here, right? Boom. We got a liquidity sweep, and then while we took the liquidity, we created fair value gaps, multiple fair value gaps, right? Now there's something called an inverse fair value gap. Is when a fair value gap gets inversed and price reverses. So this is the perfect strategy from what we learned so far. We got we got a downtrend, right? Downtrend, and then lots of resting liquidity. All the banks and stuff right here want to get in. So boom, they take all your money, and then they inverse this fair value gap. Price naturally wants to go retest the fair value gaps, the ones that have not been mitigated yet. They're like, price is normally drawn to it. So boom, inverses right here, goes back, taps into it, and then boom, rips all the way up. And there's multiple entries right here, right? You could have had an aggressive entry, stop loss maybe at this low, and then target points of liquidity, right? Boom, boom. There's so much liquidity here. You got liquidity. There's so much liquidity here, right? Price is also drawn to it because all the big banks and stuff, they wanna get filled and take your money, right? So yeah, and you could have had a little bit more patient, waited a little bit patiently, and then have your limit order right here at the fair value gap. Expect a retrace. We're in the middle of this fair value gap. The CE of this fair value gap, bro, I'm actually getting sick of saying fair value gap, dude. Stops right here, and then you would have banked 4.12 R. But there's also a good possibility that price might retrace down to this fair value gap. So that's why you gotta wait for more confluences, and you would see this fair value gap get respected before you enter. That's how I would play, but yeah, everyone trades differently, man. So people will enter off here, maybe like here, maybe like the top tickers and stuff. They probably would have entered like down here, but for me, I probably would have waited for a tap into one of these fair value gaps, give a strong reaction. So I probably would have entered off this candle close, and then I would have my stop right below this inverse fair value gap, and I would target I would have multiple take profits. I would have my first take profit here, second here, and then I would have a runner that goes all the way up here. Right? That would have gotten you a 5R. But everyone trades differently. My model is to be safe, and I have a high win rate. So I would wait for confluence that it's respecting it. So, and it will rip up. You can find so much of this, so many fair value gaps here that has been respected and does work. But there's also a lot of fair value gaps that don't mean anything. Like for example here, we're in a range, we're in consolidation, right? Normally, good traders, they would not trade when price is ranging, when it's consolidating, because it's unpredictable, it's very manipulative, right? So it creates so many fair value gaps here, but what does that mean? It doesn't mean anything because we're just consolidating. Okay, here's another example of fair value gap, right? I mean, a liquidity sweep fair value gap entry. We have a swing low, a lot of orders. Banks are trying to get filled, right? And there's also another point here that is sweep. So price goes down, takes all this liquidity, right? And then it creates a fair value gap right here. Boom. And then it gets reinversed. It gets inversed right here. And then you could enter off right there. Target previous points of liquidity. Like that. Right. This one didn't get a retrace. It fair value gaps, they either get they can go either three ways, right? It can either just run without retracing at all, or it can fully tap into it, like fully fill this fair value gap and then go back up. Or the most common one is it taps into the middle point, the CE of the gap, which is right here. It's like the most common that price would where's my brush? Okay. It would go up a little bit, it would retrace into this middle point, and then it will go back up. That's the most common. Okay. Here's an example, right? Fair value gaps can also be combined into like one big gap, because right here we can combine all these gap into one big gap, and then price taps into it, taps back into this gap, and then rips straight down. You see this big reaction. All right, let's find another example. Okay, this one taps into the middle point, the CE of the gap, right? Kinda. And then it just goes down. It gives a reaction and goes down. Also, if you want the best way, the best like win rate, you would have to not just only look at the small time frame. Look at larger time frames like 5-minute, 15-minute, an hour, 4-hour, and daily. Okay, you guys gotta keep this in mind, right? The higher the time frame, the more value it holds. So if, for example, the 1 minute, it it shows that maybe it's like going down, right? Maybe it's in a downtrend, and the hour shows that it's going in an uptrend, but I mean, it shows that it's going down right now. So whatever the higher time frame is, the more value it has, right? So all of these look like they're going downwards. So that would put our bias, our daily bias, um our daily bias to being bearish. All right, here's another example on the 4 hour. Boom. You see how precise that is, dude? It leaves a fair value gap, right? And then it taps into the midpoint and then goes straight down. All right. What you can do is pair it is to improve your strategy. You can pair your high time frame to your low time frame. So there's a fair value gap here. My strategy is basically you go on high time frame, maybe an hour, 4 hour, 15 minute, find a PD array, whether it's a fair value gap, a rejection block, an order block, a breaker, whatever, dude. Whatever kind of PD array. Just mark out the PD array, and scale down to a lower time frame. Boom. All right. It taps into the gap, right? It creates a fair value gap, like right here. And then it inverses strongly with this fair value gap, and then it creates a retrace. It taps back into this gap, and then rips straight down. So you would have your short position enter off the reaction right here, stops at the swing high, and then target previous levels of liquidity. It's that simple. All right, okay, guys, that's the video. Wait, actually no, I'm gonna show a couple more examples actually of my strategy. Okay, let's first go into the hourly. This is another picture perfect example. Boom. Fair value gap marked out. It taps into the, let's go down to the small time frame. Taps into the fair value gap, and then gives a reaction. Gives the reaction here, inverse. Have your long order right here after the inverse. Maybe you would wait for retracement, but it didn't retrace here, and the target these levels liquidity. Yeah, and you would have banged out. That wasn't a good example though. Okay, let's find another. Fuck, my throat hurts, dude. Let's go more recent. All right. Another example. Fair value gap. Scale down. 5 minute. And then look, price taps into it, creates a fair value gap here, right? It inverses, taps back into it, it fills it, and then boom, rips all the way up. You would have banged out. Hold on, let's see how much you would have banged out if you took this trade right here. If you took an aggressive approach, boom, 3.2 R, 5.3 R. And if you would have taken um a retracement approach, it would have banged out. You would have had your order at the midpoint, and you would have banged out 4.6 R. Or if you caught the full move, it would have been 7.12 R, right? But let's be realistic here. No one's gonna catch the very top of the move. All right. Or you could have entered off my model. I would have waited for a retrace and then a strong reaction, which is this candle here, and then I would set my order right here, gone right here, stop loss at this swing low, and then boom, would have banged out 4.8 or 3R. Alright, it's that simple. That's the video. I'll see you guys in the next time, and we'll be talking about some more stuff.